The main three players, actually we discussed this last week. So we have hedgers, we already discussed. Arbitragers. So what is arbitrage? We discussed the meaning of arbitrage, but don't worry, this we are just talking about the terms. Later I will show you for each of these strategies how you really can do it with real examples, right? And then you will fully understand. For now, I'm just slowly, gradually, I'm talking about them to introduce these terms to you. So for arbitrage, as I said last week, they benefit from, they make profit on mispricing, right? Mispricing. So arbitragers, actually the main purpose for financial derivatives is just for hedging. But later other people went to the market for making just money from buying or selling the instruments, which are speculators or arbitragers. Arbitragers, they, for example, they check the price of different assets and see if, because we expect the price of the underlying asset and the price of futures contract on the underlying asset. These two move together. Sometimes you see that, oh, they are not moving together. This means there is arbitrage opportunity. So we will discuss later, but so arbitragers, they closely follow quoted prices of the same asset or instruments in different markets, or looking for price differences, or similar contracts or similar underlying contracts and underlying assets, but different, different prices, right? For example, you expect the price of different types of oil increases together, or you expect the price of maybe 6-month futures contract and 3-month futures contract of oil, they move together, right? But one day you may notice that, oh, these two have not moved together. Then there is arbitrage opportunity, right? We will discuss this later. So should the difference in prices be enough to make profits, they would buy in the market the lower price. So suppose there are two similar products, or there are two contracts that you believe they should move together, right? So once you notice there is mispricing, then what you do? Mispricing means one of them is overpriced, one of them is maybe underpriced, right? So what you do? You sell the one which is overpriced and you buy the one which is underpriced. And what is the interesting thing about arbitrage? This is risk-less profit. Means you won't be often you take the position and you complete this arbitrage strategy, you have guaranteed profit. The profit is independent from price changes. Right? This is the beauty of arbitrage. But it's very difficult to find it. So many financial institutions, they spend millions on computer networks and experts to monitor the instruments in different markets, because they want to find these mispricing. So often they find any mispricing, immediately they implement the arbitrage strategy. They buy the one which is underpriced, and at the same time they short the one which is, or they sell the one which is overpriced. And often they do this, it doesn't matter what happens. This is guaranteed, this is riskless profit. We will see later. So for arbitrage, this is the strategy, right? You remember we had a strategy for hedging. I said you take an additional reverse position on the same underlying asset, and I already gave you an example for cocoa farmer and cocoa farmer and confectioner, right? But here, this is the strategy for arbitrage. Later, we will use them in real examples. So for arbitrage, as you can look at the table provided here, the nature of mispricing. If futures contract is overpriced related to spot. Spot means the asset price in the market, right? So if so you compare the futures contract price and underlying asset price. If futures contract price is overpriced compared with the underlying asset price. For example, if it's palm oil, right? If the futures contract on palm oil is overpriced compared with palm oil, then what you do? You sell or you short futures contract. At the same time, you long or you buy spot. Spot means palm oil, right? Another example, another way, another case. If futures contract is underpriced compared with spot price, compare with spot futures, it's unpriced relative to spot price. In this case, this means that, for example, again, on oil, palm oil, let's say on palm oil, if futures contract on palm oil is underpriced, means it's too cheap compared with the palm oil in the market, right? Then you always sell the one which is too expensive and buy the one which is too cheap. So you long futures, means buy the future because underpriced, and sell the palm oil which is overpriced. And this means arbitrage. Later I will give you more examples. So the third group are speculators. For speculators, they just go to the market and they don't do hedging. They usually don't go for arbitrage. They just predict the price, right? They just predict. So they take naked position. What is naked position? Means they don't offset the position. They take risk, right? For hedging, they reduce the risk, but the speculators, they take risk. So for speculators, for example, I go to the market and based on different analysis that I do, I say the price of palm oil futures contract, I believe it will go up. So what I do, I buy. Later I will sell. So if I was right, I make profit. Otherwise, I will lose, right? Or I believe the price of a futures contract will go down. What I do, I sell. I sell. But I will make profit if I was right and the price went down. But if I was wrong, it's a loss for me. So for the speculators, it's risky, right? And there are different types of speculators. It's just a name. So we have day traders. Usually in a day, they just buy and then at the end of the day, they sell. Or they sell and then they buy. They just trade in one day and make profit or loss. Then the second group, actually scalpers, it's very similar to day trader, but they will trade on large volume positions. So they find small mispricing and they will trade large, they will put a lot of money on it. And position trader, they usually go for longer term. For example, they take position for several weeks or months. For example, they say palm oil futures will be more expensive in 6 months or 3 months or 1 month. Then they will take position. So it's just a name. Actually, it's not really big issue. Okay, guys. This is the last thing. Actually, there's one more very small thing after this, but this is the last very important thing I want to discuss today because we will be using this formula a lot. So, what is this? Okay, let me show you first. Okay, you remember this slide? Yeah. You remember I said futures overpriced or futures underpriced relative to spot. I'm referring to the table, right? So how to know whether futures price is overpriced or underpriced? Right? This is very important for arbitrage, right? How do I know futures price is overpriced or underpriced? This is a formula that we use to compute the fair value of futures contract. It's called cost of carry model, right? CoC model. So you need to memorize this because for futures and options, I won't provide the formulas because there are not many formulas actually in the exam, for the exam. I don't remember, but I think this is the only formula you will have, if I'm not mistaken. For formulas, not much formula. I think this is the only one. I don't remember. So anyway, let's discuss this. We want to compute the fair value, the fair price of futures contract. How to determine? The formula F means the futures price. And we develop this formula, we construct this formula from the seller's point of view, right? From the person who is short, who wants to sell this contract. So we always start, because you remember we discussed this, I said in the very first slide of the first topic, I said that the futures or financial derivatives, their price is derived from the underlying asset price, right? So the underlying asset price determines actually mostly the price of futures contract. So the formula starts with the spot price. Spot price means the underlying asset price in the market. So I write here S0. S means spot price. And actually I don't see my mouse. What happened to my mouse? I don't know. Okay, it's here, back. So this is spot price today in the market. So the futures price is a function of spot price. So spot price means if, for example, we want to compute the palm oil futures price, it's dependent on the palm oil price today in the market, multiplied by 1 plus risk-free rate. Why risk-free rate? Because I said you construct this formula from the seller's point of view, right? So from the seller's point of view, because if you are selling futures contract, means that you will complete this transaction, let's say 6 months later, and then you will receive your money, right? So because the seller will receive his money or her money in 6 months time. So this means that there is an opportunity. Have I written this here? Yeah, I have written this here. So there is an opportunity cost of later payment, right? So if I'm a seller and you want to guarantee the price and you want to pay me 6 months later, you have to pay for the interest rate. So 1 plus risk-free rate, interest rate, plus C. C is the annualized storage cost in percentage, right? So it includes the, for example, if I'm the seller, again, we are looking at the formula from the seller's point of view. If I'm a seller and I want to sell to you palm oil 6 months later, perhaps I have to have a warehouse and put it there, right? So there may be some leakage, or there may be spoilage, or shipping, storage costs. All these must be included, right? During these 6 months that later I will deliver this product, these assets to you. So we need to add this as well. So C is annualized storage cost in percentage, and it's inclusive of blah, 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 blah. Okay. Then Y. Y is the convenience yield. Usually for most cases, there is no convenience yield. Convenience yield means any benefit for the seller. Means if you are a seller and you are you will deliver the underlying asset 6 months later. If there is any benefit, you need to deduct it, right? Because we are looking at it from the seller's point of view. But usually there is no. So in most cases, it's 0. And T, time to futures. So time to maturity. If it's a 3-month contract, this will be 0.25. It's a 6-month contract, it will be 0.5, right? So actually this formula, I think you should remember this. You have seen this before, right? This formula is future value is present value multiplied by 1 plus R power n. So it's the same thing, right? This is also called the spot future parity equation. So let's see one example. Using our example of cocoa farmer and confectioner, let's determine what the correct price of a 6-month cocoa futures contract should be if we have this information. Spot price of cocoa given here. So this is the price of cocoa today in the market, right? It's traded at cocoa itself. It's traded at 98 ringgit per ton. Then we have risk-free rate 6%, storage cost 5 ringgit per ton per year, and there is no convenience yield in this case. So let's construct the formula. We have it here. And this is the accurate way to compute it. So it's a 6-month contract, right? We start with spot price 98, 1 plus 0.06 is the risk-free rate, and then 0.051. Why 51? Why it's not 5%? Because it's, you remember here, it's annualized storage cost in percentage. So this is 5 ringgit per ton per year. You need to divide it by 98. So 5 divided by 98 is 0.051 and minus 0. And power is 6-month contract. 6 months means 0.5. And if you compute, it's 103.30. Now, so the price of futures contract, 6-month cocoa futures contract should be 103.3 based on the information we have here. So you compute this and go to the market and check the market price of 6-month cocoa futures. If in the market the price of 6 months cocoa futures was above 103.3, this means that it's overpriced, right? It's overpriced because the price based on your calculation should be 103, but if in the market the price now is 110, it's overpriced. So what should you do? You should sell the contract, right? This means arbitrage opportunity, right? So let's go back here. Yeah. So look at the table. So if futures contract is, for example, you compute the fair value should be 103. And now in the market is 110. This means futures contract is overpriced related to spot. Why? Because this formula is futures contract based on spot price, related to spot price. So it's the same thing. So futures, if it's overpriced related to spot, then you short futures contract, you sell, you immediately sell, click on sell of the futures contract, which is traded at 110. At the same time, you buy cocoa. You buy the underlying asset at the same amount, right? This means riskless profit, means guaranteed profit. This is arbitrage. If the price of this contract is traded in the market at $100, this means the second one. Futures contract is underpriced. So you buy the futures contract and you sell the asset at the same time. And this is riskless profit, guaranteed profit. Okay. And one more thing I want to share with you, two very small things. Yeah, not much more. So, sorry. Corona. I can't believe that I'm talking for 2 hours non-stop. Convergence. Okay. The price of futures contract, which is the dashed line, and spot price, it means the underlying asset price. It means the price of futures contract and the underlying asset price, they should move together. They move together, right? And on the maturity, at the maturity day, they should be the same. If they are not the same, there is arbitrage opportunity. So just keep this in mind, right? This is called convergence. And what is basis? Basis means the difference between futures price and spot price. So here in this figure, the difference between these two curves, these two lines, is called basis. And basis risk can be seen as a tracking error. And basis risk would be present whenever there is any of the followings. Number one, asset mismatch. For example, you want to buy or sell something, cocoa, but there is no futures contract on cocoa. Then in this case, you need to find something similar to cocoa, which its futures contract is available in the market, right? So something with high correlation. So sometimes I want to, for example, I want to, let's say I want to hedge, I already own gold and I want to hedge the price changes risk of gold. I want to reduce the price changes risk of gold, but there's no futures contract on gold in the market. So I need to check what futures contract has the highest correlation, what asset has the highest correlation with gold. Let's say silver. Then I will use futures contract on silver. This is called cross hedging that I have mentioned here, cross hedging. So there may be asset mismatch. There may be maturity mismatch. Maturity mismatch means I want to hedge. Maybe I need to buy or sell something on 1st of July, but there is no contract on 1st of July. Maybe the contracts available are on 1st June or 1st September. So there is maturity mismatch. Quantity mismatch means I need, for example, 150 kg of cotton, but the contracts available are the size of each contract is 100 kg. So what can I do? This means quantity mismatch. So all this will contribute to this risk. And we discussed this is just a term for this subject. We just need to know the meaning of it. So contango and backwardation we discussed last week. So the price of futures contract is higher than spot price. This is contango. For backwardation, the price of futures contract is less than the spot price. So sometimes maybe the people believe that because the supply or demand for some products in the future will change, as a result the futures contract will be higher or lower, right? Or maybe there will be some benefits for people to buy something to take delivery, maybe, or deliver it 6 months later. So in this case, maybe the price of futures contract will be higher. So it's just a term. And one more thing, open interest and daily volume. Open interest is the total number of outstanding contracts for a particular contract month, and open interest is measured from either the buy or sell side. Okay, let me give you an example just to make sure you understand. And so suppose today there are two people, right? Let's say Ali and Sarah. Ali and Sarah goes to the market, right? To the futures market. Ali long and Sarah short. Ali long, Sarah short, the same futures contract, right? This means that the daily volume is 2 now, right? But what about open interest? Open interest is 1, because open interest shows it represents its number of outstanding contracts, right? So one contract has one buyer and one seller, one long, one short. So you just need to count number of buyers or number of sellers, and they are equal, right? So it's different from volume. So Ali and Sarah goes to the market, and then let's say one of them go long, one of them short. Ali goes long, Sarah goes short. Means Ali buys, Sarah sells. This means volume increased by 2, but open interest is 1, because there's only one contract now. One has bought it, one has sold it. The next day, maybe Sam goes to the market and Ali was long. Now Ali shorts the contract and leaves the market. Now Sam long the contract and enters the market. Now Ali is out of the market, Sam is in the market, right? So Sam now is long and Sarah is short. So what happens? Daily volume increased by 2 because 2 things happen. Ali went short and left the market, means closed his account, and then Sam entered the market and he's long. So volume increased by 2. Now open interest didn't change. So the changes in open interest, 0. Why? Because still we have one contract in the market, but now the buyer is Sam, the seller is Sarah. You understand? This is the meaning of open interest and daily volume. The last thing I want to discuss today, the choice of futures delivery month for hedge depends on the timing of expected cash transaction in the cash market. The best situation is when futures contract expires at the same time as the cash transaction takes place. Not always possible to coordinate transactions perfectly. The best situation is to trade a futures contract that expired after the final cash transaction takes place. I'm sure you didn't understand what I said, so let me show you an example. The example is very clear. In the corn futures contract, the following delivery month are available. So in the futures market we have futures contract for March, May, July, September, and December. So now, state the contract that should be used for hedging when the expiration of the hedge is in June. Suppose, so March, May, July, September, and December, these are the futures contracts available in the market. But you want to hedge for June. When you want to hedge for June, you see there's no contract for June, right? Actually, you don't care. The best way to hedge is just, the rule of thumb is to choose a futures contract that has a delivery month as close as possible to, but later than the month containing the expiration of the hedge. So for June, what is the next month available? The contracts are available is July. So if I want to hedge for June, I use a contract, a futures contract expired in July. Next one, B. If I want to, actually you don't, the mouse still again came back. So if you want to hedge for July, what is the next month, the earliest next month that we have? September. So if you want to hedge corn for July, use September contract. If you want to hedge for Jan, you use March contract. So this is just a rule of thumb.